Well, new economic data out today, raising more questions about the strength of the U.S. economy. Consumer spending rose marginally in September, while the Fed's preferred inflation gauge came in at its weakest reading since January. The data coming after the Federal Reserve cut interest rates by a quarter point yesterday. And the move's getting negative reaction from President Trump, who took to Twitter, no surprise, saying, quote, people are very disappointed in Jay Powell and the Federal Reserve. The Fed has called it wrong from the beginning. Too fast, too slow. Let's bring in our guest, Danielle DiMartino Booth. She's the CEO and director for Quill Intelligence. Danielle, when you look at this statement that came out yesterday, along with a press conference, it seemed like we saw a very subtle shift here. On the one hand, the Fed moving from signaling a rate cut and this consistent stance to act as appropriate to more of a, we're going to just wait and see. What do you think prompted that?
Well, if you read the September minutes, there were several members of the committee who were not comfortable with the markets constantly dictating monetary policy. They actually said, I think that we should put language in the statement that indicates that we are not going to be slaves to the market and say we have eased sufficiently to offset the drag from the trade war. And I think that the hawks definitely had their way in terms of the verbiage in yesterday's statement. But to your point, it seems like Chairman Powell's a bit conflicted because the word appropriate was taken out of the statement and it was replaced with assess, meaning the Fed is now hyper data dependent. I mean, this is data dependency turbocharged, which I think markets are picking up on today. And yet in his press conference, he did use the word appropriate over and over.
Okay, so let's listen to what he had to say in that press conference.
There's a lot of practice and science and history in terms of how much you put in the actual post-meeting statement as opposed to what we say in the press conference statement. It's a judgment call. I'm saying it now.
So he seemed to sort of say, don't read into it too much in some way. We know what goes into a statement, but here's how I feel. My question to you is why does the Fed see the need to pause now? If you look at the data set, it hasn't all been positive. Much better than other countries are performing, certainly. But it's all pointing to sort of a slowing trend.
Sure.
So why the timing now?
So I think that Powell's kind of Cinderella dream outcome, if you will, is to have a repeat of 1995 and 1998 when Alan Greenspan was able to come in and put 3 rate cuts out there and step back. But to your point, though, in 1995, we were at the beginning of an economic expansion. In 1998, we had long-term capital management, a big hedge fund blow up, and it was kind of an idiosyncratic moment that the Fed had to address. So we were in a different stage of the economic cycle, and I just don't think it's realistic for him to be able to step back completely. But if there is a 4th rate cut, that breaks with the historic precedent of engineering a soft landing. I think Jay Powell wants for the markets and investors and Americans to believe in this soft landing thesis he has. I don't think it's going to happen.
There's also been a lot of questions about the expansion of the balance sheet. And I wonder, going in and buying $60 billion in U.S. Treasury debt, how much of that operation has allowed him to back off on the interest rate cut? And is that, ultimately when you connect the dots,
right,
is that a sign of QE?
You are getting to the crux of the matter. In a million years, I don't think that anybody would have thought a year ago, when the Fed was double tightening, by the way, they had quantitative tightening going on in the midst of rate hikes. But I don't think anybody would have guessed that there would be double easing going on. And that's really what we have right now. $60 billion a month is not chump change. It's a large dollar figure when you figure that at the height of QE3, it was $85 billion a month. Now, Powell maintains this is at a different spot in the curve. It happens to be where the U.S. government borrows a ton out to that 1-year mark. But it is still a form of easing that I think he hopes will offset the need to continue cutting rates.
Let's talk about the trade impact because the chairman has raised this many times. Yesterday, he seemed to suggest that things are moving in a positive direction when he talks about the risk. And he specifically pointed to the trade issue, saying trade developments, if signed, put into effect, could have the effect of reducing uncertainty. And yet today we've got news. Sounds like deja vu again, where Bloomberg is now reporting that the Chinese are not so committed to a long-term deal. What happens if there is a meeting between President Xi and President Trump, no phase one deal is signed? Does that put the Fed back in a more aggressive rate cut cycle?
Well, it certainly does, and it does it very quickly. And I think that the game changer today is, according to the Bloomberg story, is that the Chinese have lost trust in President Trump's ability to negotiate. And that is, I think, what markets are keying off of today. Look, we had a bad Chicago PMI number, and a lot of the data has been softer than what we would think. But I think 90% of what's going on today has to do with the fact that a tweet didn't do it. A tweet from President Trump did not cause the markets to rally, and it looks like the Chinese could truly be stepping back. There's no 60% deal, and the most important things, intellectual property and what have you. That's not going to happen. I think that that's clear at this point, and Powell can say that the trade war has been adequately addressed, but we have seen serious seepage into the services sectors of the U.S. economy that employ 4 out of every 5 Americans. So that's not something that he can attribute to the trade war anymore.
Daniel DiMartino Booth, always good to have you in studio.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.